All right. Good evening, everyone. I'm just going to give it a minute while everyone starts to join the room and transfer over. And I'm seeing all the attendees growing. A lot of familiar names in the Zoom room tonight. Thank you so much for joining CSOMA's Tuesday night webinar series of 2026. We're so happy to have you all here. As you may or may not know, we come together the second Tuesday of every month in this year to provide you with valuable continuing education, free for those that don't need credit, inexpensive for those of us that do. Dr. Julie Tran, our president, is putting into the chat. Let us know where you're coming in from. We love to see all the variety in the room. So I'm Ra Adcock. I'm your executive director of CSOMA, and I'm so excited to have everyone here. I want to make sure I see some San Jose, some Los Angeles. People are joining from all around. We usually get a couple people from out of state too. And you know what? It's tax time. So tonight we're not talking about clinical points and herbs. We are talking about business development and practice and some of the nuts and bolts that make sure that we have our most successful practice possible and that we reap as much money from our practices as possible and make sure that we're staying in compliance. So we'll be talking about all of that tonight. I am just going to quickly share with you guys. Where is my CSOMA? Here it is. I just want to make sure that you are all in touch with the resources available to you through CSOMA. Julie, does that look good? Am I sharing my screen? It looks good.
Yes, it does.
Okay, here's CSOMA's website, csomaonline.org. You can go here to check out all of the amazing things. If you're not already signed up, please sign up for our newsletter. Here's a quick link. Join CSOMA. You can join if you're not a member. There's so many member benefits. When you go to membership, you can see the pricing to become a member or to change your membership status if you've got a new status going on, if you've joined a doctoral program or you're in a different year of your practice. So you can change your membership level. Membership benefits are all here. They're listed out really beautifully. So we have all of our partners here: malpractice insurance, health reimbursement accounts, the journal. All of these different member organizations are bringing you benefits to help you reduce costs. So Blue Poppy, Fat Turtle Herbs, Golden Flower. There's too many here. Oh, here's James here tonight. Look at that.
Yeah.
Woohoo, we got James in here. Health concerns, James, Jane app. You can click on all of these. So let's click on Mayway and it'll show you, hey, here's what you get off. Here's your discount code. Here's their website. Here's a little info. So make sure that if you are a member, you're collecting all your member benefits. And if you're not a member, go check out all these benefits because membership pays for itself. We have designed this program so that if you use the benefits of CSOMA, it pays for itself while you are advocating and supporting the profession. So a couple things to highlight. Here's our webinar series right here. Look, boop, I'm just going to click on that. Here's the first 4 months right here. Oh, well, we're already we're going to keep it going. So we're in March right now with James Frame tonight. Next month, we have Dr. Toe. And then we have a conference coming up. And then we've got more. We have got Dan Bensky coming in May. So we've got some really fun things coming up. So make sure that you're signing up. And then make sure you know about our conference. So if you're in Southern California, come and check us out on Friday, May 1st and Saturday, May 2nd at Yosan University. We will be having a wonderful conference and expo. You can register here. Here's our speakers: Kath Berry, all the way from Australia, coming to visit, Mark Ryan, Lorraine Wilcox, Rob Hoffman. We've got so many other people. So here is all of the details here. Julie and I will be presenting a town hall. We've got a really fun class with Emily, who does our social media, helping you understand how to maximize your social media. Referrals, we've got a really cool panel with a bunch of speakers coming in. And Lorraine is going to talk about heat therapy and some other things. So listen, there's just so many good trainings happening. We want to make sure you know about it. I'm going to stop sharing. For those of you who are in Northern California, we're having a conference for you too this year, the end of September. We will have registration up for that in about a month or two, and it's going to happen on Thursday and Friday, September. Julie, I always forget, is it 26, 27?
24th and 25th.
Always wrong. September 24th and 25th in Oakland, we will be having a Northern California event. So, couple things. Make sure you're joining every Tuesday night. You can trace the link in your registration to take a continuing education for this. It's 2 CEUs. And I just renewed my license and I got all my CEUs through CSOMA. It's just amazing. I'm so proud of what we're offering. So with that, I just want to make sure you're getting your newsletter. Every Saturday morning, the newsletter goes out. Make sure you're coming every Tuesday night for all these great webinar series the second Tuesday of every month. Join us in early May in Southern California at Yosan for a conference. Join us in Northern California in September for a conference. And keep your eyes out. There's some legislative stuff happening. We'll be updating you on that. Some bills being introduced. Of course, we'll always be defending Medi-Cal benefits when the governor releases their new budget in May. So we're here to protect you, protect the profession, and continue to advance your education and help you be as successful as possible. With that, I'm going to zip it. That's enough promo for CSOMA. I'm going to turn it over to CSOMA President, Dr. Julie Tran.
Hi, everyone. Thanks for joining us at 7 o'clock on a Tuesday night. I have the pleasure of introducing James Frame, who works closely with held businesses and focus on holistic financial planning. He helps navigate the waters of retirement benefits, buy-sell agreements, executive benefits, insurance needs, and financial education. He looks forward to meeting with you and showing you how the complex and sometimes confusing topics can be simple and to your benefit. All right, Mr. James, you're up.
I said I would zip it, James. I'm sorry. I want to say one more thing. Hey, you guys, if you have questions tonight, put it in the Q&A, put it in the chat. Some of the questions James will take before break or at the end, but if it's a timely question, James, I'll let you know that it's there. So don't hold your questions. Go ahead and get them logged and we'll be tracking them. Now I turn it to you.
Awesome. Thank you for that introduction here. Let me get my screen going. It's great to see everyone on here, to see the participants. I saw in the chat people are coming from NorCal, from Los Angeles, from all over the place, which is great. But we're going to go over some pretty important topics today. So let me get my screen up real quick. And we don't want that one. We want the second one. We can get there together. All right. And number one. Great. We should see that now. Perfect. So again, my name is James Frame, Like a Picture Frame. I'm here out of the San Diego branch in La Jolla. If you're in San Diego and you know the UTC Mall, we're right across the street in those big buildings up there. I have the designations of QPFC and NQPA, and I always get asked, James, what does that mean? The first one means Qualified Plan Financial Consultant, and the next one is Non-Qualified Plan Advisor. All that means is I have an expertise that I'm designated for on helping people build out their 401ks and their defined benefit plans. So a lot of times the CEO or CFO will reach out to me if they're having an issue on their current plan, whether it be they're out of compliance or not enough money's being saved, and I'll sit down with them and help them build out a plan. The non-qualified plan advisor part is a little confusing, but some of you guys might know the term golden handcuff plan. Those are plans where we build these plans out to hold key persons that we want to stay at the company. I'll build out a plan that will help ensuring that they actually stay at the company. So that's called a non-qualified plan. Also, a little background. I went to the Berklee College of Music. Most people go, James, you went to music school. Why are you a financial advisor now? Well, long story short, I love music, but I find finance a bit more interesting. My senior thesis in school was I built a machine that took your brain waves and turned it into musical data so you could control synthesizers with your brain waves. with that knowledge, I decided I'd rather go and help people with their retirement plan. So that's kind of the background there. As far as the instructor for the law enforcement group, this is something I do in San Diego and in Los Angeles. I go to our California Highway Patrol offices, I go to the sheriff department, and I give instruction on how to properly save for their retirement. I explain their pension to them. But that's a lot of time that I spend during the week is going out and giving those presentations. And we're going to hit on some of those topics tonight for your personal retirement. And then I am also a member of the Business Strategies Group. What that is it's a group of people, advisors like myself, that specifically work with business owners on a few different topics. And I'll kind of hit on those topics of what we really focus on for the business owners is employee benefits, executive benefits, company retirement plans, and then also all the insurance stuff. So that's also a majority of my week is spent usually doing this. But what are we going over today? We're going over CalSavers. We're going over some business continuation. We're going over some tax stuff. And then we're going to take a little break. We're going to go through a lot. We're going to go through it pretty quickly. And then the second half is we're going to talk about your personal stuff. So we're going to talk about some financial fundamentals, and we're going to talk about preparing for retirement. The majority of my clientele is about 55 and above. What I wish would happen is I wish they would have come to me when they were in their 30s. And when we sit down, we build out a financial plan together, they say the exact same thing. It's, hey, James, I wish I would have came and talked with you when I was 35, 36, and kind of worked on my overall retirement, because if we could have gone back 20 years, we could have set them up a little bit better. So if you're in your 30s, if you're in your 40s, and you're like, I don't really want to sit down with a financial advisor yet, I'm not ready for retirement, the sooner you do it, the better, right? It's kind of like your health. The sooner you start working on your health, probably the better, right? All right, there's also a document that I have to read here, annoyingly, which is a compliance thing, but let me just get that out of the way here real quick. Verbal disclosure, of course. All right, so during the seminar, I'll be providing you with important information and education that is general in nature. While I may be asked to respond to questions, my answers and none of the concepts that I discussed during this presentation should be constructed to individualized advice or a call to action. Every individual circumstance is different, and I'll gladly schedule a time to meet with any of you in person or have a more in-depth discussion tailored to your situation. So with that out, and with my lawyers now probably happy, let's jump into the meat and potatoes here. I'm taking a look, and I see we got about 35 participants here. I'm taking a guess that the majority here are either an owner of their own practice or they are a practitioner with some type of ownership in the company. If you do not know what CalSavers is, we have a little bit of a problem. I do a lot of work with dentists, and I work with the Dental Association. And what we're finding is businesses that have less than 10 people are basically not enrolling. They're not enrolling, and they're not applying for the exemption. This is an issue. Since the end of 2025, anybody with a single employee must have the CalSavers plan either set up or have applied for an exemption. Now, you're probably sitting there going, I've known about it, but this is new news to me. That's totally fine. A lot of people kind of, got the notification in the mail, and it looked like an everyday piece of mail from the state, and you probably took it and threw it away, right? We do this with our mail pretty often. But we need to either get you enrolled in the CalSavers plan, or we need to get you something that'll get you an exemption, and we'll kind of jump into that. So what is CalSavers? CalSavers is California's mandated plan. They came in with some legislation. They said, hey, a lot of people don't have a good retirement, or they don't have something that's offered by their employer. So we need to make a plan that everybody can contribute to. And I'll get to that, why we have that in a second here. A bunch of states already have this in place. The majority of the industry thinks that there will eventually be a nationwide plan. From what we're seeing, everything's being pushed that way. A lot of legislation is in place right now that's being pushed that way. So you might as well just get ahead of it, right? Might as well just plan for it now. The states that already have them in place are about 19. Everyone else, except for South Dakota, Alabama, and Florida, are currently considering these plans. And you're probably wondering why. Well, we're in a bit of a retirement crisis right now. My job is sitting down all day and helping people hitting their retirement goals. And to be realistic, the majority of my clients are reaching out to me because they actually have resources for retirement, right? That's just kind of the nature of the business. Unfortunately, there's a lot of Americans that are living paycheck to paycheck, and the retirement plan that they have in place is either one, none, which is unfortunate, but it's just what happens. It's life, right? Or two, they're relying on Social Security for the entirety of their retirement. If you are someone that watches the news or follows along with the news, we're going to have a little bit of trouble with Social Security here sooner than later, probably in the next 10 years or so. Once we hit some certain parameters, they're going to start pulling back on Social Security. And for the people that aren't ready for that, that don't have savings or a retirement plan in place, there's going to be a lot of suffering. All right. So Congress, legislators got together and they said, hey, we got to do something here. So what they came up with is a state mandated plan. They said, all right, what we'll do is we'll create a plan that everyone must enroll in if they're an employee, and they will get auto enrolled in it to try to incentivize them to start saving for retirement. All right. So besides the retirement crisis with the Social Security, what we're also seeing is that a lot of the other resources are being pushed on because of longevity and also rising healthcare costs. We're all experiencing that at the same time, and that's dipping into a lot of people's savings prematurely. The savings that were put aside for the retirement are disappearing very quickly. So kind of a side note here. Something I saw in the past 2 to 3 years within my industry is a lot of people will reach out for a thing called long-term care. And that's because the price of a home or the price of going into a place to be taken care of in the end of life is costing like $138,000 a year. In California, long-term care, the average right now per year is $138,000. So you take a look at your retirement account and you take a look at what's happening, and you can see, hey, if I went into a home, all these funds that were supposed to be given to my children or to my grandchildren can more or less disappear in 4 years. So there's a lot of stuff going on. But to come back to CalSavers, something that the state did to try to help was start this plan. All right. So what is it? Again, it's state sponsored. You got automatic enrollment, meaning if you don't have a plan in place that's registered and makes you exempt from CalSavers, you will automatically have enrollment in this every single year. Meaning if you enroll in this and the employees sign up with it, they will automatically be enrolled every single year. If they don't want to be involved with it, they actually have to log into their account and say, please unenroll me. Again, we're trying to incentivize people to save, right? These are all going to be set up as a Roth IRA, a Roth individual retirement account. If you don't know what that is, it's the conversation of pre-tax versus post-tax. With a traditional IRA, you put your money in an IRA or a 401k, and you can now deduct that from your actual taxable income, right? With a Roth, that just means everything is going in after you pay taxes. There's 2 reasons for this. One, Uncle Sam always wants his money. All right. At some point, you'll be giving Uncle Sam your money. And then number 2, the big benefit is that it grows tax-free, and then when you take it out, it's tax-free as well. We'll get into that concept a little bit later with your personal retirements, but it's just the way this was set up. It's always going to be a Roth IRA. The contribution rates for these is going to start at a default of 5%. So if someone's in the Cal Savers program and they're not really paying attention, they're going to look at their paycheck and they're going to see that 5% is just gone. We know that this is going to cause some issues, but it's what the state has put in place. All right. And then every single year, it's going to go up 1% until it stops at 8%. Now, the employee can choose a different rate. That's one of the benefits. They can say, hey, you know, I actually only want to do 2%. I only want to do 3%. But the default's going to be 5. Then it's going to grow to 8 because the recommendation is, you know, as most of us know, is usually 10% we want to put towards retirement. But they stop at 8. If you want to choose a rate, you can go and choose a different rate. What are the actual investment options through this? The majority of it's going to be what's called a target date fund. If you're not familiar with that, we're going to go into that in a little bit more detail later. But the basic concept is you say, hey, I want to retire at age 65. The investments will automatically over time readjust for you, usually becoming more conservative at the age of retirement, but it'll just do it automatically for you. So if you jump in at age, say, 25 years old, you say, I want to, retire at age 65, it will start off with a bunch of equities or a bunch of stocks. You'll own a bunch of those. You'll have less bonds and less debt obligations. And then over time, that will just readjust. If you're the type of person that doesn't enjoy watching the news or watching the investments and how they react to market volatility, it's a great choice to get in. You just set it, forget it. When it comes time to retire, you open your account and you see what's sitting in there. Some of the benefits and the purpose of the plan is one is accessibility. Before this was in place, you kind of had to look for an employer that had a retirement plan. That was one of the benefits, right? A lot of smaller businesses just never offered something usually because of high turnover. But there was also a large segment of the society that just wasn't offered it because they didn't make enough money, right? With this, they're opening the doors for everybody saying, hey, this isn't really a benefit anymore. It's now more of a right or an obligation, all right? The other benefit is flexibility. Again, if you were to go into a privately sponsored employer plan, they get to dictate a lot on how that 401k is set up. Even to the point of you not being able to access the money at all, sometimes not even be able to access it after quitting the job. I had a case about a year and a half ago where a employee got fired from the job, and in the 401k plan, there was a stipulation that he couldn't touch the money for at least a year. So even though it's his money, there was a small little part in the 401k plan that said, hey, you got to wait a year to touch your money, right? With this, there's none of that, all right? There's none of that, which is great. The other big benefit is portability. Because this is not attached to an employer, it's your plan, right? It's your thing that you can take anywhere. You can do whatever you want with the plan. It's not attached to an employer, all right? So that's kind of the basics of the Cal Savers. And I kind of am playing it up in a little bit too much of a positive way because a lot of people really don't like these, doesn't like this plan at all. And I'll get into that in a second. But I personally do like it because it does give access to a plan to everybody, which I think is super important. So a quick overview about this. Again, it's fully funded through the employee, through payroll deduction, all right? Most of the companies that I work with are set up with this by now. Paychex, all the bigger ones that do payroll, they're pretty on board with this, which is good. It's completely voluntary. After your initial automatic enrollment, the employee can just go in and say, unenroll me, or I want to jump it back in at any time. And then a big thing is that this is administered by a private sector financial service firm, and then it's overseen by a public board. And you'd probably sit there going, all right, well, why are you kind of hitting on this point? Well, in the private sector, uh, people like to have good customer service. But when something's implemented, customer service tends to fall to the side, right? So if we think about the Fidelities of the world, the John Hancocks, Equitable, any 401k provider, they usually try to do a good job with their customer service. They usually try to keep call times down when you're trying to ask a question. When you try to implement a rollover or a transfer of funds, usually the person's pretty nice on the phone, right? Well, when it's state mandated, that one kind of goes out the door. Let's see here. CalSavers. Oh, this is interesting. It used to have a review of them. Looks like that may have been taken down. But there used to be a review here, and it used to have a rating of about 1.5 stars. So let's just use the Facebook one. We're looking at about 1.7. If you want to have something put in place for your company and you want it to be a net benefit for your employees, I would probably look elsewhere. This is, again, something that was just set up for the mom and pop shops, the people that really didn't want to get anything put in place. But for everybody on this phone call, I would recommend either getting something put in place now or just looking at the options out there. As far as the employer role, if you are the owner of your practice here, basically all you have to do is upload some information to CalSavers. It then pretty much works for itself, right? So it'll automatically do the enrollments for you, track the opt-ins, the elections. You need to actually submit some of the participating contributions to CalSavers with the payroll, but again, Paychex, ADP, all those other companies have that already in place for you. The big benefit, why employers like this plan, again, usually the employers that have high turnover, that don't have practitioners under them, is there's no fees. All right. So when you set up your own 401k or your SEP or your Simple or something like that, there's always going to be either soft dollar fees or hard dollar fees that are associated with the plan. California thankfully saw that that was going to be happening, so they actually have some credits that you can utilize to offset some of those costs. But this is, again, a big one for people that just didn't want to have a plan in place because of the fees. The state came in and said, hey, we'll put this for you totally for free, no fees associated with it. All right, the deadline and the registering your exception time, this is why we're talking about it, has passed. December 31st, 2025, that was the last date. So anybody on this phone call or this Zoom meeting, if you have one or more employees, you need to be enrolled. You need to have registered for the exception. All right. If you have not done this yet, the only thing I can recommend you to do right now is right after this Zoom meeting is just jump on the website, maybe put a favorite icon on it and start that process. We'll get into what the fees are if you're not enrolled here in a second. It's not too crazy, thankfully, but you just want to get it taken care of. The other question I do get asked is, well, what if the people are part-time employees? Doesn't matter. If you have any employees, more than one employee, one or more, and they're over 18, you gotta enroll. All right. So what are the exceptions? How can we get out of this? Pretty much any retirement plan that's out there, you can utilize for the exception. All right. For the majority of people on this phone call, I'm going to point your attention to a couple of them. The 403Bs don't work for most of the people on here. A SEP would work just fine. A simple plan would work just fine. Your 401k plan is just fine, or a payroll deduction IRA with automatic enrollment. That's the key. A keynote, though, is just fine as well. Something that I've run into issues with a few times is people say, oh, yeah, we have the payroll deduction IRA set up. We've had that set up for a while. If you had it set up more than 3 to 5 years ago, I would double check with whoever the provider is and make sure that automatic enrollment is set up. Back in the day when we were setting up IRAs, automatic enrollment was kind of a rare thing, especially for deductions, because the majority of people would just do a traditional IRA rollover. And on the paperwork, you would never select automatic enrollment, right? So there's literally millions of these out there where they're just missing a single checkbox. And that's all it is them going back and saying, all right, we want automatic enrollment, and that will verify you for the exception. All right. The big thing we see a lot of people getting into are, of course, your 401ks, but they can be kind of expensive, is jumping into pooled employer plans. I saw a big increase in this in about 2 or 3 years ago. And what a pooled employer plan is it's simply a 401k where a bunch of different companies are all in that plan, unified under the umbrella of that one 401k. What does this do? Actually, the company that I contract with, they are seeing a ton of this, is it gets rid of your fiduciary role. So it reduces it so you're not responsible or liable for the fiduciary aspect of the 401k. So, maybe you know this or maybe you don't, but if you set up a 401k and you are the one that's overseeing it, you have a fiduciary role in that. So if an employee gets angry at you or says, hey, why don't you select this type of investment for me or whatever, they can turn around and sue you. That's something that most owners don't want. They don't want to be that person. So with these pooled employer plans, it's basically a bunch of companies are putting their funds into these 401k like entities where it's exactly like a 401k, but now a different company is that fiduciary, right? But that's a really easy one to take care of this problem as well. Cool. So what happens if we do not comply? Well, we're going to get hit with a $250 non-compliance notice, and then after that 90 days, we'll be hit again with a $500 one. So for everyone on this call, yeah, it's kind of more of an inconvenience, right? It's not, we don't want to pay the $500 or the $750 if we don't comply at all, right? But if you think about this, this really was kind of targeting the big box entertainers. So think of Best Buy, think of Target, think of Walmart, the people that have 20,000, 100,000 employees. You take 100,000 times it by 250, 100,000 times it by 500. Now we get where the incentivization comes from, right? To do this, all you have to do is just go to calsavers.com, all right? And it's going to prompt you with two things. For the savers, for the people that are in the plan, you just got to click it, and it'll guide you right through with your social security number and get you right there. For the employers, again, same deal. You just go through, register with it, plop in your EIN number, boom, should be automatically done for you. I think they did a good job on the digital structure of this. Again, the exception or enrollment. So how can we help? Of course, we do, like I said, with my designations, the NQPC and all that stuff, we do a lot of simples. We do a lot of SEPs, 401k. The way that I work is I'm a bit agnostic in who I work with. What does that mean? So if you see in the bottom left corner there, you see Equitable. Technically, I contract with them, but when I do my work, part of the contract with them is, hey, when I work with a client, I'm going to look at whatever is in their best interest, right? So I sit down with you, we go over the plan, we say, hey, you have 10 employees, you have 20 employees. What then I go and do is I try to go get quotes from all the different companies out there, whether it's Fidelity, John Hancock, Voya, Empower, whoever, is I go out and I build the plan for you with whoever has the best offering. So if you're sitting there right now going, James, do not have a plan set up, and I need to start looking at some stuff, give me a phone call, send me an email. We'll sit down together. We'll get this figured out for you. We'll knock it out. Um, that's the easiest thing that we can do. Simples are really easy to set up. SEPs are really easy to set up. 401ks, depending on how big the company is, that can vary. So if you're with a company that has, say, 20 people, maybe a month or two. But if you have more than 100 people, we're looking about 3 to 6 months. So what I want us to take away from this is the deadlines. All right. If you don't have something set up, let's do it. Also, if you want to look at the tax credits for the startups, those have started to waver out. There's still some available, but I just Google tax credits for CalSavers. That should pop up pretty quickly for you. I think there's a couple $1,000s that is still out there. If you do have a startup plan, that should probably cover the cost for you. All right. So I'm going to stop there for a quick second, and we're going to jump over into our business continuation thing here. While I'm switching over here, Dr. Rod, is there any questions just yet?
Hey, James, I'm not seeing any, not in the
Perfect.
chat. And yeah, but bring them on if you, oh, there's two in the Q&A. Hold on. Nope, nope, we're all good. Thanks. Thanks. Keep going, James.
Perfect. All right. And let me see how we're doing on time here. We're doing good. Perfect. All right. So business continuation. We're going to talk about some business continuation planning and some exit strategies.
James,
Again,
actually, I'm going to interrupt for 1 second. I'm so sorry. I'm
go for it.
just seeing a comment from Michelle Lau. It says, as a sole proprietor or independent contractor with no employees, you're not required to participate in CalSavers, but you can voluntarily join the program. It says voluntary on the website. Is there an advantage or disadvantage to signing up? Great question, Michelle.
Yeah, so everything is going to be based on how much you can put in your retirement. So with an IRA, you got about $7,000 you can put away. With some other things, the 7,500 away that you can put each year in retirement. As a solo practitioner, you'd probably want to look at a solo 401k, and that gets you into the area of putting away about $25,000 a year. So with an IRA, they put these limits on it for whatever reason because of the IRS code on how much you can put away. With the 401k, you can put away more. I'm not going to go into super detail about this because I nerd out a little too much on this stuff. But if you look at all the different names of all the different retirement plans, that's all based on IRS tax code. And that's just the limits that were made kind of arbitrarily out of the tax code. So IRA, think 7,500. With your 401k and the solo 401k, it's going to be 24,500. And then with a solo 401k, you can actually add on to it things that are called like cash balance plans, things more of the non-qualified plan stuff that I talked about. For dentists in particular, they end up doing a lot of that because as they get older, they had put a lot of money into their practice, and so they need to now catch up in retirement. So a real life example from last week is I was working with a woman that has her own practice, and she had put millions of dollars into her practice. She has hundreds of thousands of dollars of student debt still, right? She's in her mid 50s and she's starting to look at retirement. She wants to retire when she's 75. Well, currently, right now, if she was only able to put away $25,000, it would take her, 2 decades. And she's like, hey, the time frame doesn't work out. So by utilizing the solo 401k, and then we came up with a cash balance plan, a few other things we added on top of it, she's now able to put, about $250,000 to $300,000 away each year in retirement that helps her catch up, right? The majority of people that work in the regular workforce, think of the office person, they're putting away, $20,000, $30,000 a year, and over time that grows, right? But for someone like her that's a solo practitioner, maybe like yourself, where you've been putting so much money into your practice, when it comes time for retirement, you need to kind of catch up, right? So you can utilize those um, different items that we use. But I hope that answered the question. I didn't go too much down the rabbit hole. But anyways, let's jump into business continuation planning and exit planning. This is something, again, we see a lot with our dentists, with a lot of solo practitioners, some doctors. I'm working with a doctor right now. He got himself into a little bit of trouble. But this is the idea of having a plan in place to sell your business when it comes time. One, sell it. Two, give it to a family member. Or three, just get rid of it somehow, but you need to get some money for it. So let's jump into our planning here. So we're going to, one, get into the importance of planning. We're going to talk about valuing your business. I think last month there was someone that kind of got into that, which I'm glad to see they popped up on this question, because we get asked a lot of questions about this. Three, we're going to talk about our planning options. And then four, we're going to talk about funding the actual plan. We'll get to the meat and potatoes of that. So the importance of planning. I want to give kind of a real life example of this. Two things I've worked on. One is going to be what you don't want to do, and the two is kind of what you want to do. So about a year ago, I sat down with a client. We went over his current business. We ended up not talking about an exit strategy or continuation. We kind of talked about the underlying holdings of the business and what they want to do for the investments. But we'll call this guy Tom. Tom had inherited this company, an HVAC company, from his father. He ran it with his sons and with a couple of friends that he brought on from college. They did not write up an agreement of any sort. It was all a handshake. So a few months ago, it was 4 months ago, 5 months ago, he passed away, and there was no formal agreement. There was no trust. There was not even a will that was put in place, which is kind of shocking for someone with his amount of net worth. There should have been something in place, but he just didn't have it in place. What happened? First, the partners started arguing with each other, which is expected. Some phone calls were given to me, in which I simply had to say, I have nothing to do with this. I help you guys with your investments for your business, but I'm not a lawyer. Don't get me involved in this. I don't want to get sued. And then it turned into arguments with the sons amongst each other. And then they started arguing with the partners that were the owners, technically, based on the handshake. What happened? Everybody turned around and started suing each other. Currently, the business is not working at all. From what I heard from one of the sons and one of the partners, all business has ceased. And this company was bringing close to about $15 million, $15 to $20 million a year. I was supporting a bunch of people. They're losing clients left and right. What could have solved all of this? Right? What could have solved this whole thing? An exit plan, right? A business continuation plan, a properly funded buy-sell agreement. That would have solved every single issue. My second client, who is a lawyer, she works out of Poway. She did the smart thing, what I want to see everybody do. And she's a lawyer, so she already knows about this stuff, inherently. When she started her law firm, she immediately got a business exit strategy in place. She immediately put a buy-sell agreement in place with her two partners, and it was all set up. She is now retiring last year, and we sat down, we looked through her exit strategy together. And it was one of the first times where it was a plan that was better than anything I could even put in place. It was perfect. It was, hey, the majority of this is going to go to my sister. When I pass, this is going to be paid out, and that will go to my son. Everything's in place. And because she put that in place, she doesn't have to worry about anything, and she gets to retire in peace. That's what we really want to do. So what we're going to try to put in place here today or learn about is being person number two, right? Having that plan in place. So what happens when an owner dies? The owner's family wants a few things. They always want the top dollar for the business. They always want the prompt payment or settlement for the business. They always want the fixed value for estate purposes already done. The family usually wants to separate from the business if there's another partner or another owner, and they want there to be no conflict. Now, if you have a business plan in place and an exit plan in place, that happens. If you don't have that in place, none of this happens, right? So what usually happens is we'll start at the bottom. Conflict happens immediately, right? If there's not an agreement in place, if there's not something that states, hey, this is how it's actually done in a legal document, there's going to be conflict, right? And that's with the family themselves. Now let's go over to what the business partner wants. They always want full control. They want the business to be uninterrupted. They want to pay the least amount they can for the remainder of shares of the business. They want no interference from the heirs, which is usually doesn't happen. And they want uninterrupted access to credit. Okay. You can already see where the conflict is starting to happen. If you look at point number one, the owner wants top dollar for the shares or for the business. You look at point number three, what does the business partner want? They want to pay the least amount. All right. So inherently, there's going to be conflict. So with a continuation plan, what do we need? We need a few things, and this will help everybody out on this phone call. If you have this in place, you can sleep well at night. Your spouse can sleep well at night. You know your kids are going to be taken care of. But what you want to do is you want to identify who's going to actually buy your business and when. Right? If you're currently working right now as a solo practitioner and you haven't thought about this, I'd probably start thinking about it. You know, there's a few marketplaces you can go out and start to see what other businesses are being sold for, but I'd probably talk to some friends if they're in the business, or when you go to the next conference or the next seminar, say, hey, you know, how did you value your business? What are some offers that you're getting? In the dental space, what we're seeing a lot of right now, and in the veterinarian space, is private equity is coming through and buying up a bunch of stuff. So that's a pretty easy way to value the company. I haven't seen private equity hit acupuncture practices just yet. I kind of think they're coming down the line at some point, though. So with the plan, you want to identify who buys and when. You want to establish a fair price. You want to get that on the books, what it's actually worth. From there, you can establish what the estate tax value will be, how it will affect your personal estate. If it was to be sold, how would that go back into your estate, and how would that, offset the taxes? But it also helps encourage confidence in the business. So if your employees or your partner knows that there's a plan in place, it just helps overall confidence. Hey, what if they do get sick? What happens if someone can't show up and help bring in some business? All right, what are we going to do next? Right? But this will also consider the needs of family, co-owners, and employees. This is probably the most important, is going to be family. I really, really, really don't enjoy having the conversation with a spouse of a deceased talking about this stuff. It's very hard to have that conversation. If you just have a plan in place, they get to grieve. They get to put that away, but you really don't want to have to be thinking about business stuff when a loved one just passed. So when is a plan actually going to be needed? And you definitely want to plan before you hit these road marks, is going to be a retirement, right? Hey, it's time for me to retire. I'm in my 60s. I'm in my 70s. I need to sell my business. You want to have that plan in place. What happens with dentists? Or I had a radiologist have this happen, where the radiologist last year, where he sat down, I'm ready to retire. I want to retire next year. Technically, his business was worth about 4.8 million. It was enough to retire, but he couldn't find a buyer. So we had to sit down and build out a plan, find somebody, and we realized that in order for him to retire and get the net value out of the business, he actually needed to stay another 6 years while moving the business over to the person that was buying him out. So you want to get ahead of that, right? You don't want to be retiring the next year, say, hey, I'm going to sell my practice, and then it comes time and there's no buyers. That's not a fun situation to be in, right? The other time you need this is when there's a disability that happens. This is really hard to plan for. Again, that's why you want a plan in place, is you want it before someone becomes disabled. When it comes time to sell to a third party, you want to know the value of your business immediately, right? You want to know, hey, what is the actual value that I can get for this? The one we don't like to talk about is a voluntary or involuntary termination, right? If you have a few partners, or if you're with a co-op and everyone decides that for whatever reason they don't like you, well, you want to have it on a piece of paper what you're actually owed, right? I had more than a few examples of that where, for whatever reason, the partners say, hey, he's not holding up his end of the deal. Also, the bankruptcy of an owner, that's a hard one. But the ones we see often is going to be for divorce and then death. When someone passes, again, if a plan's not in place, things fall apart pretty quickly. Divorce, that gets real ugly. Usually it's a lot of times it's a man, but if it's a woman, either way, when your ex starts coming after you and they start looking at your business, you kind of want something in place saying what your business is actually worth, what's the cash flow on it, etc. Because if it's a really ugly divorce, they're saying, hey, you're making a ton of money. Maybe you're not making as much money as they think you're making, right? And they start asking for a bunch of crazy stuff. So the other important part of this is family businesses. Like I said, I'm working with a doctor right now. There's 8 people that are employed by him. The plan was to give the business to his 2 daughters. It's a private practice, and both daughters went to medical school and they got their degrees, and they came back and said, hey, Pops, we want to go work for the hospital. We don't want to be private practice. And I think one ended up going into working with people with severe disabilities of some sort. Point being is that they didn't want to actually take over the business. So in his case, we're now sitting together coming up with a business plan where, hey, we're probably going to sell out the business, probably to a private equity firm, unfortunately for him, or just sell the land, and then that land will actually fund his retirement, right? So you want to think about that. A lot of the times, the plans we have in place today are not the plans of the future, right? So let's look at a quick case here, a kind of meat and potatoes, what we see often. We're going to use a story of Steve, Kathy, and Jim. They're in a plumbing and heating business. Again, we see this kind of over and over again. Steve and Jim are partners. Steve's wife, Kathy, is a teacher. Steve passes away 6 months ago. And you probably are guessing where I'm going with this. As far as the ownership, Steve is a 75% owner. Jim is 25% owner. How did they actually figure out the ownership? They shook each other's hand, right? They decided they'll buy each other out, but they never put it in writing. There was never a legal document. So what happens? Let's just assume that Jim's a good guy. And Jim has been paying Kathy for a little while. He said, hey, I'll take care of that obligation. I got you. Steve was my best friend. We've kind of heard this story a few times, right? Don't worry, Kathy. Well, things aren't going so well. For whatever reason, the cash flow isn't what it used to be. So Jim stops paying Kathy. Now she's having a hard time paying the bills, right? Well, now Jim would like to take over the business still, but he doesn't have any money to take it over. And of course, the conclusion of this is Jim and Kathy can't agree on the value of the business. Now they are arguing with each other. If this was real life, they're probably going to go sue each other. They're probably not going to talk with each other. They're probably going to lose a lot of money in court fees. And that could have all been taken care of with a continuation plan, right? In this case, what would have taken care of pretty much all of this is just a buy-sell agreement. A simple funded buy-sell agreement. The whole thing what would have happened is Jim would have got the money from the life insurance. He would have bought out Kathy. He'd now be 100% owner of the company. And this would have all been spelt out in the agreement, right? And Kathy would now be financially supported. Some people don't really know what I'm talking about, a buy-sell agreement. I'll go into a little bit more detail on how these are funded here in a second, but I wanted to kind of cover the value of the business. I don't do evaluations of businesses. I work with a couple companies that do that. I'm not an actuary. As much as I love talking about investing and working on retirements, there's only so many Excel sheets I can look at in a day. So we want other people to come in and evaluate your business for what it's actually worth, right? But when you are valuing a business, here's kind of some basic concepts you want to think about. What does the IRS think your business is worth? That's going to be all based on taxes, right? The other part of the value of your business is going to be what the actual seller will accept. And in some cases, we see this being an issue often, specifically for plumbing and HVAC stuff. They think their company's worth a lot more, and then someone comes in and goes, actually, based on realistically, it's worth maybe about 75% of it. And then the seller, the person trying to get rid of it, ends up just saying, forget it, I'm not selling this company, right? Kind of a little bit of an ego thing. There's also what a buyer would offer. You have to be realistic about this, all right? What is going to be the actual offer coming in? And then we get to kind of the nuts and bolts of it. What's the book value of your company? And then what's also the liquidation of the value, the liquidation value of your company, right? If you're to sell everything, get rid of all your tools, how much is going to be sitting in the vault after that, and all that good stuff. Let me jump back here. Yes. So an accurate business valuation could do a few things for you. One, it's going to help you lock in the sale price. What we see a lot of is when the business is not properly evaluated, is there's a lot of back and forth, right? Your lawyer talks with their lawyer, talks with their lawyer, going back and forth, bunch of wasted time, right? This will help with your reducing your estate taxes because you can prepare for it now, right? If you get a bunch of money that you weren't expecting, well, now you're going to have to deal with those taxes, right? It's going to reduce your legal costs because you already have it in place. You don't have to talk with the lawyers. It's going to improve your lines of credit. It's going to reduce delays and disputes because, hey, this is the real number. And then it's going to provide fair treatment for the heirs. They now know what's coming in. There's a realistic plan, all right? For everyone on this call, there's going to be a few other things you want to think of aside from the things we just talked about as far as book value, liquidation, all that stuff. When you're working with a professional corporation, someone like myself or yourself, it's not only the hard assets that we have that provide value to someone buying us out. There's a lot of other things you want to consider. But the main consideration is going to be goodwill, right? It's also going to be what's the client base like, right? So when you sit down every day and you go through your client list of everyone that's coming in to get a session with you, what does that actual cash flow look like, right? So for people like myself, for people that are on this phone call, you don't want to just take the hard assets and utilize that for the valuation, but yeah. So other people like myself in this position are going to be CPAs, attorneys, engineers, physicians. If you want to make a really hard and fast, easy valuation of your business, you basically just want to take 1 to 3x of your annual revenue. So if you're saying, hey, I'm bringing in 150, 200K, all right, the business is actually worth 600K, right? That's kind of the fast, easy way, but I would reach out to somebody that can actually, evaluate your business for real. But if you want to do a hard and fast, it's 1 to 3 annual revenue. For people in my position on financial advisory services, we just do 3x. So if your book of business brings in, 250K a year, great. That's 750K that your business is worth, right? All right. So some planning options. What do we want to do? We covered a couple of these. If the owner dies, one, we just want to liquidate the business. All right. This is what most people do if they don't have a buy-sell agreement set up or a properly funded continuation business plan. Two, the family inherits the business and runs it. I see problems with this all the time. I use the example of plumbers. A lot of the times the son will try to take over the plumbing company. until they learn real quickly that Pops was actually really good and really talented at being a plumber and that it's not the easiest thing in the world. Then they try to go sell it, right? The interest can be sold to the deceased families. Again, that's if we have a good a plan set up already, that's pretty easy. And then the deceased interest sold to surviving owners or third party. Again, that's if we have a plan in place for the exit strategy or the continuation strategy. So we're going to cover the buy-sell agreement here in a little bit of detail. Why am I doing this? It's because everyone on this phone call either is a sole practitioner or they have a group of partners that they're with, and there's usually 3 to 4 people, right? Some people that I work with here in San Diego that are acupuncturists, it's usually, hey, I'm a sole practitioner, and then I work with another company on Tuesday and Wednesday, and then I work at another location on Saturday and Monday, or whatever that organization is. So technically, they work for themselves and 2 other companies or another partnership, right? So a buy-sell agreement will fix a lot of problems for that. You have these already put in place, someone, passes away, unfortunately, you can put this in place. So buy-sell agreements, what do? They tell us who's got to sell, who must buy, what the triggering event for that is. It's going to give you the formula for actually valuing the business and how that formula was laid out. It's going to lay out the terms of payment, and it's going to say what the funding is, how the funding was put in place, and what we'll pay for it, right? So how do we actually fund those plans? There's going to be 5 different ways here. Cash, which is always ideal. Cash is king in this world, right? A sinking fund, which I'll get to in a second. Loans, which we try to stay away from if possible. Installment sale, again, we try to stay away from that because they can fall apart. Or the simplest version is going to be life insurance for that one. So let me kind of go back and talk about the sinking fund here for a second. So cash, again, we hit on this one. This can basically be, all right, we set aside, I don't know, 100,000, 200,000, 300,000, whatever, to pay out for the shares here. And a lot of times that'll be put into a savings account of some sort, either a high yield savings account, which I would highly recommend. Right now, rates are still pretty good, 3%, 4%. Or you can put them in CDs. You can put it in some type of an investment account if you want. I'd probably keep it conservative to get some type of growth. But that's cash. It's anything you can access in less than 3 days. You take that and you can pay it out. The other source of funds is a sinking fund. If you aren't familiar with that, it's kind of like a savings account or kind of like cash, but just a little bit different. All it's going to say is there's some legal terminology or jargon that goes with the sinking fund. Sinking fund is an account that's set aside, but now funds are going to go into it based on an agreement. You say, hey, we're going to set aside, say, $1,000 a month, and it's going to keep going into this fund until it saves up $100,000, at which point the funds will just sit there. And when the funds are needed for buying out the partnership, we're going to go into that sinking fund, and that will pay for it. Sinking funds can be, again, held in a few different ways. If you want to hold it in a savings account, a high yield savings account, you can do that. You can put it into a brokerage account. You can put it into an investment account of some sort. But again, the idea is simply saying, hey, we're putting funds, we're sinking funds, right? The name of it, we're sinking funds into this fund for an obligation in the future. And we will be giving regular contributions to it until that obligation is settled. Loans, this is a last minute. This is a, hey, we have to change our lifestyle a little bit. We need to take out a loan in order to survive. This is a last ditch effort to take a loan. I really don't like doing that. The installment sale, again, that's totally fine as long as the agreement's written out and the person actually has the funds for it. Where I see installment sales fall apart is basically people use too much good faith. They know the person, they like the person. They say, they'll be good for it. I know they'll have the money eventually. And then the time comes for the actual sale itself and the entire thing falls apart. I have seen that unfortunately, many, many, many times. And then life insurance. Life insurance is just going to be, hey, me and the partners are all buying life insurance on each other. And so when they pass, we get the funds and we take those funds and we pay off the spouse. That is the most simplest, basic way of getting these things done. If for some reason you're in a health condition where that doesn't help, I would then go to the sinking fund or to cash. But again, this is just an easy thing to take care of with life insurance. Say, hey, we're all partners. We all have obligations. We're all going to buy life insurance on each other. We're each going to pay, I don't know, $100, $200 a month, whatever it is. And our obligations are settled. It's just a very simple concept. All right. And great. I think that gets to the end of this. So kind of cover the points here, the importance of planning. We just want to make sure this stuff is done, guys. There's been so many times I've sat down with people, and if we could just get a basic plan in place, that'd be great. Definitely, if you have not got your business valued yet, I would go out and get your business evaluated. The sooner, the better. And about every 5 to 10 years, get it redone, right? You definitely want to have those planning options in place as fast as you can. If you are in a partnership right now and you don't have something in place, definitely reach out to your partner and talk about setting this up. And then you also want to think about funding the plan. So with that in mind, we're going to take a quick little 5 minute break here. So if you need some water, some tea, whatever, go ahead and do that. We'll all get back here at, how about we take a 6 minute break? So we'll come back at 8:12. If you have any questions, go ahead and put them in the chat there. I'm also going to put up a flyer here if you want to sit down and go over some of the things we're talking about. I got this QR code that makes it super easy. That'll just guide you to my booking apparatus, and we could set up some time in a few weeks, go over that. If you need a retirement plan, again, we'll sit down and get that knocked out for you. But everyone, go get some tea, go get some water, and we'll jump back here in a few minutes. Thank you. All right. I think we're jumping back on here. Hey, Dr. Ra, how you doing?
Good, James. I'm just checking in, and I want to make sure that you're seeing there are a few questions um in the Q&A. Can you see the Q&A? Do you have access to that?
I do. Yep.
Yeah.
Oh, I see one about the recommendation from Ray Kung from Transworld. Yeah, that'd be a good person to reach out to for business
Yes.
valuations.
So Dr. Julie put that in because Ray did a lecture for us in January about business valuation. And hey, y'all, you can go back and find that video in our archives. And then I guess one of the questions that came from Jocelyn is, do you have to do auto deductions if we have an SEP or IRA, or can we do this occasionally?
Deductions. Oh, I think she means enrollment.
Or
So
maybe contributions, maybe?
contributions.
Yeah.
Yep. Yep. No, so it's gonna be the audio contributions should be selected. What I mean by that is whoever you have this through, when they were going through and they were setting up this account for you, they had to set up automatic contributions, right? If most people back in the day didn't select that, because when we set up our own IRAs, most of us would take money and just move it over to an IRA. So the business itself or the world itself of banking is not really used to auto contributions like we are with our 401ks. With our 401ks, when you're setting up a 401k, it's usually in the plan that it's going to be automatic. And the payroll has that implemented, paychecks, whoever, what provider you're using already does that. With the IRA world, that's not really a thing that was people are used to, right? So now with the auto contributions, whoever you have it set up with, you want to call them and say, "Hey, is that button selected?" Because the reality is it's probably not. The majority of people just don't have that set up yet.
Okay, great. Thanks for that. And one more question from Chris. And I think everyone's just wanting clarification on this. In regard to CalSavers, what if you are the only employee of your company? What are your requirements then?
There are none.
Okay.
Yep. So that's it. It's if you employ the one person, right? So besides that, you're fine.
All right. I think we're up to date with questions.
Perfect. All right, let's jump into. All right, yeah, we're running a little short on time. I'm gonna jump into some personal stuff here for everybody. We're gonna jump into some retirement stuff. Um, Let me get my screen sharing here. Do. Looks like that's good. Great slideshow. All right. So what we want to talk about is retirement. Uh, the majority of what I do is retirement work. Um, and the majority of people, like I think I stated before, are people that come to me when they're 55, when they're 65, and they say, "Hey, I got this money here. What do I do?" And that's when we start talking about their investments. We go into their wealth management, all that stuff. Uh, but every time we have this conversation, it's usually, "Hey, I kind of wish I would have talked to you 20 years ago," right? Why is that? A lot of it is going to have to do with taxes. The majority of it is, "Hey, we should have probably been putting more money in a Roth account or a Roth-like vehicle," because people will retire and they say, "Great, why I don't want to pay taxes anymore," right? And I say, "Well, unfortunately, you have to pay your taxes." But what we're going to talk about is kind of retirement readiness, a little bit of the taxes about how you should start planning now to make sure you're not paying a huge tax bill at the end. I think the majority of people on here don't have a pension, which is sometimes a good thing, sometimes a bad thing. But with the police officers that I work with, they have a huge pension. And so what we focus on is almost entirely on how to save in non-taxable ways, right? Because their earned income will always be high and they'll always be paying a bunch of taxes. But let's get into retirement. So This could be some pretty basic stuff, but we really want to make sure we have the fundamentals down, and I want you to feel secure in your plan, right? We don't want to panic. What's happening right now within the political landscape is affecting a lot of people's retirements, but the people that have a plan in place know to stay the course. So as long as you have a plan, you'll be all right. So how much do you need in retirement? There's probably some people on this phone call that listen to some people out there that will say there's rules or methodologies of figuring this out. It's pretty basic, right? It's pretty basic. You say, hey, I think I need $80,000 or I need $100,000 in retirement. And all you're going to do is you're to say, how long do I think I'm going to live? So if you're going to retire at age 65 and you think you're going to live to 85, well, you got 20 years, right? And so you're going to say, hey, if I want $100,000 each year, you do 100,000 times 20, right? That's the fundamental math of the stuff. That's the really basic stuff. Where it gets a little more complicated is where you have the cost of living adjustments, the COLA, you have inflation, um, but the big one is the medical needs. And I really recommend sitting down and figuring out a retirement plan that includes long-term care, that includes a medical need, right? As much as we all want to be healthy, we all want to be vibrant, especially with this group that's very aware of their health. Hopefully, the acupuncture and the herbs and the healthy foods will help us avoid um, disease and cancer and all that stuff. But you really want to plan for those events either way, because it can just wipe you out. So in this case, yeah, pre-retirement, which you're now, what you'll need for retirement. This one uses 16 years. I like to use 20 years. When I plan for retirement, most people at currently pass at age 85, especially for men. For my calculations now, I usually run 30 to 35 years for women. Um, Women are living a lot longer just because that's what usually happens. But the rule of thumb is, hey, 20, 30 years, right? And then you also want to add in what your rate of return is, which I'll get to in a second. So as far as living in your retirement, how long you'll live, here's what we're kind of seeing as far as the math. Again, 20 to 30 years. That age is rising. Um, so if you really want to be safe, you might want to go for 40 years. Just plan for 100 years, all right? We all make the joke with our clients that, hey, if I get to 95, I'm just going to end it, right? But we don't want to do that. We actually want to have a plan, and we don't want to have to rely on others within our old age. Lifestyle is a huge one. Back when financial advisory and wealth management, I don't want to say it was in its infancy, but was back in the 50s and the 60s, lifestyle and retirement was a lot different. So when someone retired at age 50, they looked a lot different. They acted a lot different. There wasn't travel, right? The entertainment resources of the 1950s and 60s was a lot different. The idea of traveling the world and going on a fishing trip or an expedition or going to Japan was totally crazy, right? And so when people would plan for retirement back then, it was a lot simpler. Hey, I go work the 9 to 5 job. I have X amount of dollars that I've saved up. I'm probably going to pass away in my 70s because we smoke, we drink, we eat a lot of meat. That's life. So they have these core 20 years of savings, usually a pension, but their lifestyle was a lot different back in the day. Nowadays, when we are thinking about retirement, this is really important. We want to think about our housing. Hey, realistically, are we going to stay in our house? Is the house paid off? Maybe we want to move to La Jolla or we want to move to Florida. We want to have a second condo, right? This is something you want to start thinking about now, right? It's a thing that we didn't used to think about in the past, but a lot of people have secondary housing, and you want to make sure that you can actually afford that in retirement. You don't want to have to start selling assets in order to survive in retirement, right? You want to think about traveling. Back in the day, people didn't travel. Now travel's a easy everyday thing. And if you want to travel the world, you want to start budgeting for that, right? You also want to think about what your food's going to be like. Are you going to be cooking a lot of food? Are you going to be ordering a lot of food? Are you going to get some delivery type of service for your in your retirement, right? And then entertainment, gifts, and utilities, the basic stuff. You just want to start thinking about that lifestyle now. And most people don't think about retirement. They don't consider the lifestyle they want to have in retirement until it's a year or two out. But if you're my age, I'm 36, or if you're in your 40s or if you're in your 50s, if you could start thinking about what your lifestyle will actually be, you're better prepared for it in 15 or 20 years, and you can start saving towards that. So, hey, you want to have a little money set aside to go travel to Japan every single year, it's already put in place for you. All right. So, income sources for retirement, these are all the things that you want to pay attention to and you want to keep a close eye on. I'm going to kind of point out a few things here. For the majority of people on this call, pensions are not going to be available. With the public sector that I work with the police officers, with the teachers, we rely heavily on pensions for their retirement planning. For everyone here that's in the private sector, including myself, we don't have that, right? And so the responsibility for our retirement is entirely our own, which can be kind of scary. All right. I know that. Pensions, it says, hey, you're going to give me a defined amount every single year for the rest of my life. I can kind of relax a little bit. Oh, the 401ks, the IRAs, those are more of the fun money stuff. But for everyone on this phone call, the fun stuff for the people with pensions is the really serious stuff for us. All right. So you want to think about your income sources for these. So think about your 401k, your 401a, whatever you have set up for you. Think about your IRAs and all that stuff. You also want to think about Social Security. You want to make sure you get that calculation done. I absolutely love the update that Social Security has put in their system where you can now log in and see what your credits are now. Back in the day, it was kind of a black box, so to speak, of what's Social Security, and they go, I think it's something or a calculation or whatever. Now we can all have access to our Social Security benefits and what we actually get paid out for, which is great. Um, on that note, like I said earlier, for people that are in my age group and in their 40s, I do start to have the conversation now where it's, hey, we don't want to be dependent on this. We need to start saving more funds for our retirement. Investment income, I'm not going to hit on that a whole lot. Investment income is if you have like a brokerage account or something where you're taking your after-tax funds and putting it into a brokerage account and it's growing, you can include that in your overall retirement portfolio. I try to keep that out of the retirement portfolio until you're in retirement. Why? Usually the investment income portfolios fluctuate rapidly and are open to volatility. So I try to keep that outside of the retirement picture for now. All right. So you may have to provide half your retirement. We know that. A lot of this is going to vary, but the reality is that, hey, we need to start preparing for retirement ourselves with the ownership of the business, with the retirement funds, with the IRAs, with all that stuff, right? A closer look of Social Security. What we're thinking and why we're showing this is most of us know how Social Security works that's on this call, but I'll kind of just get into it is, hey, you have a lifetime income and then you have the survivor benefits. Now, if you make more money than your spouse, you'll probably just want to keep your own. If they make more money, you'd want to switch over. It's going to be based on a formula. Again, I would just go onto the website itself. Most people try to push taking Social Security until their 70s for a little bit more money. But what this is showcasing is that the system's starting to get stressed. Why? Everyone's starting to live longer, right? So if we think of one of every four people that's 65 today living to 90. All right. Well, if 1 out of 10 lives to past age 90, right, which is going to happen, that starts stressing the system. My parents, I like to use them as an example. My dad's 81 and my mom's 73. Back in the day, a man living to 81 would look like a person that could barely walk, someone that could struggle to say a sentence, right? My pops goes out and he plays music every day for an hour and a half. He goes to the beach every single day. They both go to acupuncture. Actually, the reason I got into acupuncture was because of my lovely mom. She was a granola mom before granola mom was a term. Um, but these people are going to live until their 90s easily. This was not a thing that happened. So it's really starting to stress our system. And when you go to the beach with them during the weekday and you see them in the water, there's a whole host of people their age that are also in the water that are probably going to live to age 100 and will stress our system out. So on that, we need to talk about how to actually save some more money, right? This is going to be talking about your pre-tax contributions, and that's going to be the term. The term is going to be traditional IRA or traditional 401k. And we're going to hit on this for a second, and then we'll jump into Roth and Roth IRAs. A traditional IRA and a traditional 401k simply means that you can take the contributions that you're putting into the account, and then that's going to be taken away from your earned income. So when someone talks about, hey, I'm trying to lower my tax bracket or I'm trying to lower my tax bill, that means that they're putting pre-tax contributions away for their retirement. And that's lowering, right, their overall earned income, what they have to actually report to the IRS. So if we want to take the example that they have here, all right, so let's say we got $50,000 and we want to put away 5%, 10%, or 15%. Great. Depending on how much you put away, that's going to lower your actual taxable income a little bit more. So instead of the 50,000, you got 47,500 that you actually have to report, that you have to pay taxes on, right? Or the 45,000 or the 42,000, right? And then that's going to lower what your actual income tax is, right? So the idea is, hey, the more money that I put away, the lower I make my tax bracket, the less I'll pay in income taxes, and the more money I can put away in my pocket. What is the benefit of this? The benefit, pretty obvious, is more money now, right? The issue is going to be Roth. What is the majority of complaints that I get from my clients? It's going to be taxes, like I said before, right? Based on your income, you're able to fund a Roth IRA. Based on your income, you can fund a Roth 401k. If you make too much money for those contributions, you want to look at some other items that are untaxable. There's two items here. One is going to be insurance grade life insurance, and I'll get into that in a second because I'm not the biggest fan of that. Or two is utilizing those funds and investing it in what are called muni bonds, municipal bonds. So I'm not going to go into those in a huge detail, but if you make too much money to contribute to the Roth stuff, you want to look at those two other options. The reason that I don't like talking about overfunding life insurance, investment grade life insurance, is it's a really complicated concept. And if not done correctly, can create really weird tax obligations. So just for kind of entertainment purposes, I'll talk about it, is a lot of doctors and dentists, they make too much money. So they say, hey, I'm going to max out my contributions to my retirement stuff. I want to have something that now has growth associated with it that I don't have to pay taxes. So they do is they take their money, and for this example, let's use $50,000. They throw $50,000 into a life insurance product. It grows over time. And then when they're in retirement, what they do is they turn around, they take loans against the insurance product. Why does that work? Well, what's one of the few things that is not taxed? Debt. So you're taking debt, right? You're taking loans against yourself and you're loaning yourself money from your life insurance. Again, it's something that's appropriate for some people, but not for most, because what happens is if you don't keep that funded, if you don't keep your eye on it, and you get, say, dementia or something like that, and there's not an advisor or someone in the bank watching over that, if that blows up and the life insurance lapses, it now becomes a taxable event. So all those funds that you were taking out, non-taxable, all just became taxable. So it completely destroys the whole purpose of the actual thing. And then for muni bonds, like I was saying, again, if you've maxed out all of your retirement accounts, that's something you want to look at, where those are just bond obligations from municipalities. And as long as you're in the state of California, any investments you put into that are non-taxable at the state level and non-taxable at the federal level. So with my doctor clients, with my surgeon clients that are a bit older, that's a place we put a lot of money into where it says, hey, let's just go put some money into these muni bonds and cycle it out and get, say, 3-5%, get some growth on it, all that. So anyways, I need to get back to the pre-tax and Roth contributions. So what you want to do, if you have a company that matches, if you so happen, if you're not a solo practitioner, you definitely want to match with them. So a lot of times the 401k plans will come with a matching contribution, usually of up to 3%. In order to get that 3%, you'll need to contribute 4% or 5%. Definitely do that, right? However you can get that 3% contribution, you want to try to do, right? That's free money. We want that free money for our retirement plan. We want to put that away. Do contributions. Oh yeah, that one. Okay. So how else can we save for retirement? But besides getting into our budgeting and getting to our 401ks, something that we always recommend to all of our clients is checking your bills. I know we all do this. We all get subscriptions, especially with the Hulus, the Paramounts, the Netflixes, and we kind of just pay subscriptions now, right? If you can, at least once a quarter, sit down with yourself, maybe sit down with your spouse, and go through your bill and say, hey, what are we actually paying? And if you're paying, $9 every month for a service you're not watching, probably time to cut that, right? Now that $8 can go into your 401k or your IRA. And although $8 right now each month doesn't sound like a whole lot, times that by 100, times that by 1,000, add some compounding interest on top of that, that can become pretty big. Definitely review your phone plan. You definitely want to see who else is out there. I'm guilty of this right now. Verizon or T-Mobile or whoever I utilize, I keep seeing my phone bill go up. I used to pay 75, now it's $90. So it's time for me to start going out and reviewing that, right? We also want to look at our insurance providers and what else is out there. So if you have a health insurance plan for your company that's covering some of your employees, you definitely want to cycle through that at least once a year. Look for what's out there. You want to shop around for your car insurance. But something I really want to hit on is checking for lost property. I had a client, it was just a month and a half ago. We were going through a financial plan together, her retirement plan, and something kind of the math just didn't add up. And so I went through and she said, there's this company I worked for in the early 90s, and I think there might be a 401k there. I said, all right, well, if it's kind of small, let's not really worry about it. How long did you work there? She went, well, worked there for like 25 years. That kind of perked my interest. If you worked there for 25 years, there's probably $1 or $2 in that plan. So I have no idea. I haven't looked at it. And said, okay, when was the last time you contributed to it? I don't know. Like, well, based on how the markets have done, this might be substantial. It was. It was a few $100,000 that she had completely forgotten about. And that actually was pretty significant to her overall portfolio. Um, She started screaming on the phone because she couldn't believe it. She thought she won the lottery. But this is a reality. There's people lose their 401ks, they lose their retirement plans. So definitely go through, check that you didn't leave anything behind. So diversification. This is something we want to talk about. When you're getting towards retirement, you definitely want to get a bit more conservative. If you're my age or if you're in your 40s, your early 40s, you kind of want to be aggressive. But how your investments are located, it's called asset location, is pretty important. I'll give an example here. I sat with a client, very conservative. No one sat down with her and really explained the difference between stocks, bonds, cash, what that, all that difference is. And so the portfolio that was selected for her from her 401k provider 20 years ago simply said, all right, she's very conservative. Let's put the funds in. Well, she was netting about 2 to 3% each and every year. What has the actual market returned in the past few decades? If we just use the S&P 500 as an example. If you don't know what the S&P 500 is, it's the top 500 companies in the United States, technically the top 503. It's one of the indices that we use to measure how the market's doing. The average on that is about 9.5 to 10.2% each year. So if she would have simply taken her funds and allocated half of them into the market, she would have seen double-digit returns, triple-digit returns on her retirement funds. But instead, it's just been slowly kind of growing and really growing because of what she's putting into the funds themselves, right? So that's what we're talking about is you really want to pay attention to how your portfolio is invested. All right. You want to take a look at, hey, is my portfolio invested in domestic, in international, in growth, value, in small, large cap? You want to have a real understanding of that because that will really affect how your 401k is going to be growing. You also want to understand how much is invested in the stocks or bonds. So a traditional portfolio, you sit down with somebody, usually they're going to say your age. So we'll use myself, for example, and we'll say, all right, let's assume I'm 40 years old. I sit down with somebody and they say, all right, well, based on your age, we'll put you in a 60-40 portfolio, meaning 60% in stocks. So those domestic, those internationals, those value stocks, then 40% in bonds, right? And that means that the 40% is a bit more conservative. It's not going to grow as much, but it won't lose potentially as much as the stocks and the equities. Inverse of that, if the market does really well, I'm going to lose out by having that 40% not in the market, right? What we've seen since the pandemic is a lot of people put the majority of their funds in tech stocks. So think NVIDIA, Meta, anything with the AI stuff, which is all well and good for right now. But for older investors, it becomes very dangerous because what happens? Well, eventually the market will pull back, right? Eventually, that's just what happens. If San Diego's a prime example of that, think of the company Qualcomm. Eventually, what goes up usually comes back down. So you want to pay attention to how you're invested. For the target date funds, this is, like I talked about, a very simple, straightforward way to kind of get around having to play around with your portfolio much. You say, hey, James, I want a simple or I want some type of IRA set up for my company. Great. What type of investments do you want in that? James, I don't really know. Great. What I'm going to say is we should probably invest in target allocation funds. Like I explained earlier, these are funds that will simply readjust over time and will readjust for you automatically. They're a great solution to utilize in a portfolio if you don't want to have to pay a lot of attention to them. I utilize them a lot because it's one of the funds that helps me helps me avoid getting sued. I won't go into that example, but well, I'll explain this. Basically, because of my designations and the way that I set up 401k plans, it makes it so I can get sued by lawyers if I'm not what's called ERISA compliant. for the Employers Retirement Act and all that stuff. By utilizing target date funds, I basically avoid all that legal mumbo jumbo stuff. Again, a really easy thing to implement. So pre-tax, after tax, like I was saying, again, if we want to lower our tax bracket, if we want to lower our taxes that we're paying now, great, traditional. If we want to benefit from the Roth contributions by putting the funds in a Roth type account, you will thank yourself many times over in your retirement. So ideally, if you're a younger employee with a longer horizon, you want to really look at this. And if you don't really know what I'm talking about, please reach out to me. We'll jump into this and get into the details on it. But I really like the Roth contributions because it satisfies everybody's wants and needs, and it just makes it so much easier to build a bucket of tax-free money. So again, if you're a younger employee with maybe 20, 30 years, maybe 40 years before retirement, definitely start thinking about this. It's well worth your time to pay the taxes now. Something that I kind of skipped out a little bit on talking about was legislation for taxes in the future. Usually taxes go up. In this administration, in conservative administrations, usually taxes are reduced, but usually historically over time, they're not. And I kind of hinted at the Social Security stuff, but if you also think about what we owe as a nation is going up more and more and more, the realistic way we're going to actually pay for those obligations is taxes. And I legally can't say anything about that. I can't say it's a guarantee. I can't say, that's the reality. I don't have a crystal ball for it. But you'd be hard pressed to find anybody that say, oh yeah, we're definitely never going to raise taxes. Everyone says we're probably definitely raising taxes. We owe billions of dollars, trillions of dollars to everybody. Therefore, we have to raise the taxes, right? So in order to get out of that, you want it to help. You want to fund that Roth type account. And then, of course, you want to try to leave that tax-free money to your heirs, right? No one likes paying taxes or inheriting funds they have to pay tax on. I don't think there's a slide on this, and I don't think I'll cover this, but with inherited IRAs, the stretch obligation no longer applies. So if you do have a traditional IRA and you give it to a beneficiary that is not your spouse, they have to take the funds out in 10 years. We dealt with a lot of that last year with a lot of clients getting money that, hey, they're happy to have the money, but because they inherited this IRA in their money earning years, their income earning years, they're now having to pay 40%, 50% taxes on that inherited fees. We want to avoid that as much as you can. So getting back to this, what are we going to be paying money on for our retirement? We will be paying for Social Security benefits. We will be paying taxes on that. For some reason, people think we don't pay taxes on that. We pay taxes on that. All right. We pay taxes to pay taxes to pay more taxes, right? We will also be paying taxes on non-Roth retirement accounts. We will also be paying taxes. So let me back up here. That means that anything, again, if it doesn't say Roth in front of it, you're paying taxes on that. All right. So I'd go back to your retirement account. I'd go back to your investment accounts and just look for that term Roth. If it's Roth, you're good. If it's not, it's not. Money you will not pay taxes on. Again, anything that's Roth. And then other investments you made with after-tax dollars. There's sometimes some confusion on this. If you take your after-tax dollars and then invest it in, say, like a brokerage account or a mutual fund, you will then pay taxes on that growth. Okay? People get pretty upset about this. I make sure they understand this. If you take your dollar now, you go to a brokerage account or go to a mutual fund and say, here's my money, and it grows, when you sell that, you will still have to pay taxes. The only item that you will not have to pay taxes on, again, is that Roth. So if you went to, say, Fidelity, to Equitable, whoever you go to, you say, hey, I want to open up a brokerage account. I would first look at opening an IRA account. So a lot of people don't know that you could, as an individual, can go open an IRA instead of a brokerage. I just say, hey, I want to open up an IRA account, a Roth IRA account, and that will help you for your retirement. The caveat to this is that money, once it's in the Roth account, you do have to wait till you're 59 and a half in order to take the funds out, or else you can be hit with some penalties. But we're talking about retirement right now. So hitting on this point here, this slide just illustrates the taxable, tax deferred, and tax deferred after taxes. If we're thinking about our taxable or just traditional IRAs, here's your blue. If you're to put the same amount in over time, you can see that the funds are starting to get depleted. You say you put in 100,000, then 21 years later, you got 223,000. If it was marked as Roth account, you would instead have about 339,000. So this is just an illustration to showcase, hey, we really want to make sure that we're saving in our non-taxable funds. So once you come to retirement age, you are going to have to decide what your withdrawal rate is. Most people on this phone call has probably heard 4%. Where does 4% come from? 4% comes from the concept, and I call it a myth of the $1 million retirement. We all live in California. I live in San Diego. You guys live in San Francisco. It's even crazier. But 4% doesn't cut it anymore off $1 million. What is 4% off $1 million bucks? It's $40,000. The reality is $40,000 is not going to help us in retirement in San Diego, in Orange County, in Los Angeles, right? You're just going to hear that over and over again because it's become a rule of thumb, and I just don't think it applies anymore. Instead, I'd sit down and I'd say, hey, realistically, I need, say, $100,000 a year, and I need that for 20 years. And that's how I base your calculation on retirement. Of course, if you need help on that, we're always here to help you, of course. Okay. And then, of course, what do we need to actually do to make these things last? Work with a financial professional, hopefully me. Don't dump all of your stocks right away. That's in regards to RSUs. Definitely don't sell everything off right now. If you're a bit worried about the economy, I get it. We see the wars, we see everything that's going on. It's craziness. We've been through this a lot, unfortunately. So, have a plan in place. Make sure you keep with it, even when crazy stuff like this happens. So, summary. I hope I gave a good, concise overview of how to, plan to retire. Again, no matter your age, I would start now. I would give me a call, or if you want to do it solo, just take the concepts that I laid out for you and start putting that in place. But I'm going to wrap it up here. We got 10 more minutes. I'm tired. It's 8:50 here. I bet we're all tired. So let's take some questions, wrap it up, and go home.
James, what a great presentation. I don't think there's much more. I am seeing a question from Eunice in the chat. And that question is, how do you check for your old 401k, like your client, if you can't remember the financial services provider that your old company went through? Larry
Yes.
did answer it. And just to make sure you said it right, with www.claimit.ca.gov, if that would be just for California.
Larry, I don't know who you are, Larry, but thank you. That's perfect. There's also a bunch of other third-party people that will do it. If you want to go through Empower, if you want to type in 401k, find it. There's for-profits that you have to pay a fee for. But yeah, that's perfect.
Great. Larry's great. A very long time CSOMA member. Always got a good answer, and so often here. And I think that might be it, unless anyone else is gonna throw in a question, last minute question. While we've got James with us, we'll certainly bring James back. It's a lot of stuff that's hard to think about, but once we engage in it, can feel really good. I know I've started to do some financial planning with UCSF where I work, and it's it was really scary, and you guys make it easier at least. So
Well,
yeah.
it's made to be scary, but once you start to learn it, it's kind of like swimming. You know, it's just you get more and more comfortable with it, and then you start to enjoy it a little bit, right? You go, hey, you know, I'm learning how to swim. Why don't I learn how to surf a little bit? Why don't I learn how to boogie board, right? So conceptually, it's like, yeah, just the more comfortable you get, the better.
Yep,
But yeah, I want
financial
to offer it
literacy.
to everybody here. Happy to sit down with all of you. Everyone at CSOMA, I've met a lot, are great people. They're fun to talk with. Any questions, concerns, reach out to me.
James, thank you so much. Julie, any last thoughts from you, President Dr. Julie?
That was a lot of information. So take advantage of James's offer to break it down and distill it for you. And my husband says the math gene skipped me, which is probably true, but that's why I'm in a profession where I don't really have to do a lot of math. So there's that. I just have to count out grams and measure out grams of herbs, right? That's all I need to do. I don't have to really totally add everything. But yes, so great. And I think we got the previous. I just want to make sure we got the previous questions before we went on the break from 8:15, like
We did,
Michelle's
we took,
question.
yeah, we took those questions right when we got back. So I think we covered all of it. Um, Yeah. And yeah, everyone make sure you check if you need continuing education credit, check your registration information and it'll guide you on how to do it. Make sure you get your 2 hours for tonight. We will see you again the second Tuesday in April, where we will have Dr. Toe with us. And I hope to see a lot of you at the Yosan conference on May 1st and 2nd down in Los Angeles. Everyone, thank you for being part of the CSOMA community. Thank you for being part of this profession and coming together under the CSOMA umbrella where we gather. James, thanks again. Julie, thanks for being our president. Everyone, have a good night. Stay safe out there. We look forward to seeing you next month.
Have a good one. Bye.
Everyone.